Investing into gold is a great way to preserve and protect your wealth, especially in times of uncertainty. In the last 20 years, we've seen the price of gold continually rise to new all-time highs, which is why today I'm going to show you 3 different ways that you can invest into gold yourself, starting with the first, which is buying physical gold. Okay, so when it comes to buying physical gold, this is also known as buying a bullion of gold, which essentially means you'll be purchasing actual gold bars or coins. In the UK, you can do this by going to a website like royalmint.co.uk, which allows you to buy bars or coins in all different shapes, sizes and weights. Let's take this 1 kg bar of gold for example. This will actually set you back around £83,000. But of course, you don't need to spend that much. If you just wanted to buy some gold for £100, let's say, there are options for that as well. Now, when we talk about the pros of owning physical gold, of course, the main one is the fact that you're going to own something real. Having physical, tangible gold in front of you is a great source of protection during uncertain times. Gold is universally recognized around the world, and you can essentially take it anywhere you want and have the ability to exchange it for cash in the future. On the flip side, a con of owning physical gold, especially if you have a lot of it, is that you really need a safe place to store it. So you might have to invest in a safe or store it in a vault of some kind, which is of course going to cost you a lot of money. Another thing as well is that gold can also be quite difficult and expensive to insure. Of course, once again, depending on how much you have. So it is really worth considering this before you make a decision on how you're going to purchase it. The next way you can invest into gold is through a gold ETF, which stands for an exchange traded fund. Think of these as special types of stock market investments that track the price of gold. So instead of owning physical gold, you're investing into a fund that reflects the value of gold. You may have heard of an S&P 500 ETF that tracks the top 500 companies in America. Well, a gold ETF works the same, but of course, just for gold. Now, in terms of where you can go to buy these, you can actually do this through an online investing app. In the UK, my recommended one to check out is Trading 212. And as you can see, when you search for gold ETF in the search bar, you're going to get lots of different ETF options come up. But let's say if you click on the top one right here, which is the iShares Gold ETF, you'll see that it's currently up around 41% in the last 12 months. Also, if you did want to sign up to Trading 212, you can get a free fractional share worth up to £100 if you open an account using my link in the description down below. It's highly worth checking out. But with that said, when it comes to the pros and cons of owning a gold ETF, it's almost the opposite of owning real gold. Buying and selling gold through an investment platform is, I would say, easier and quicker to do, and you don't have to worry about storing your gold. You just need to have a secure investing account. But of course, the cons of this is that you don't have anything physical, just the shares in a fund, and there also may be management fees associated with the fund that could potentially stack up over time. Moving on to the next way to invest in gold, and this way is a little less common than the previous two, but has the potential to be more profitable than both, and that's by investing into gold mining companies. Now, you may have heard of the term, don't try to mine the gold when you can just sell the shovels. This came from the 1849 California gold rush, when very few prospectors going for the gold actually made it rich. Instead, it was the people who sold the shovels, jeans, tents, and other supplies to the people hunting for the gold that made the most money. And I guess that's where I'm kind of heading when I talk about investing into gold mining companies. For example, DRD Gold, which is a gold mining company in South Africa, is one that you can invest in, once again using Trading 212, and at the time of recording this video, it's currently up around 93% over the last 12 months. But of course, before you do see that and go headfirst with this option, please remember that past performance doesn't always indicate the future, and just like our previous options, there's definitely going to be some pros and cons as well. Starting with the pros, as we just saw, there's actually a potential for higher returns than the going gold rate this say, especially if the company is performing really well. Another thing as well is that companies like this may even offer a dividend, so over the year you might get a little bit of kickback along the way too. However, on the other side, do remember that the stock price can also be volatile, and in this case, gold could be potentially booming, but if the stock market is rocky or something happens with that company, the price can be influenced by factors way beyond just the going rate of gold. I have to say, this is an option where research is really important, and any kind of oversight could come at a potentially damaging cost. So really do be careful. But with that said, are you thinking about investing into gold? And if so, what would be your preferred option? Let me know in the comments down below, and I'll see you in the next one. Take care.